Alright guys, here's Doc's Market Minute for Friday, February 19th, expiration day. Now, Todd and I trade totally differently. Todd trades a lot of Forex and E-minis, and I generally stick to options, but there are going to be times where I sort of blur the lines between the two, and I look to the S&P futures. I watch these all day long for kind of a read as far as what's happening under the hood of the market. It's always good to watch the S&P futures regardless of what you're trading. But I will watch these, and what I'm using here is a tick chart. So each one of these candles is printed when there's 2,500 transactions. What this tends to do is it tends to clean up the overnight price action. So instead of just, printing candles where nothing is going on and one every 5 minutes where it's just a waste of time and chart space, this will only wait until 2,500 transactions is printed before it prints a candlestick. So it tends to make the chart much more lively, and I think you can see all the wonderful waves that show up on here. And so this morning we started kind of weak, and we were making lower highs and lower lows. As you know, that's a downtrend. And then what started to happen was it started to slow down. And what I can see was that on an equal low, again, I don't want to get too day tradey here, but on an equal low in price, we had a much higher level of tick. So what that meant was that the downtrend was kind of running out of steam, and I expected to see a little bounce back up. And so what I did was I entered a very quick weekly option trade. In fact, these are options that expire today in just a couple of hours. And so what I did was basically sold an at-the-money bull put spread. So right at the money, getting right in there hand-to-hand combat with the price, bull put spread. And what I want to do is go for a 1-to-1 reward to risk ratio on the trade. So I can basically do this. This is a different time of day for when I entered this. But if I go to sell a vertical here, and if I make this, I like to make these one wide just to keep it clean. And you can see that we can sell it. I'd want to be selling a 50-cent credit for something which is at the money with a one wide spread, because that keeps that 1-to-1 reward to risk ratio. So here's the results of the trade. And you can see that here was the entry point here, right here, entry. So we're selling the 191 put. Let's go to a different color here, which might stand out. We're selling the 191 put and buying the 190.5 put a little further out of the money. And so what this does is this pulls in a 50-cent credit for that trade. Okay, so that's the trade in. And by doing that, I establish a 1-to-1 reward to risk ratio for the trade. And then what I'll do is I'll just turn around and set a debit limit to close myself. It doesn't even need to be good to cancel, because on a day like today where we're using options that expire today, that order is going to either get filled or it's not going to get filled, and by the end of the day, then I can decide whether or not I need to close it if it's not near that level. But you can see that just about an hour and a half later, 103 minutes later, this thing fired at 20 cents, and you tend to get very quick price action on an option like this that's on its very last legs before expiry. This is where we can get confusing when we start talking about options in the Greeks, because the gamma is so high at the money on expiration day. And so either that is going to be a big hindrance to you if you're trying to defend a position, or it's going to be a big assist to you, a great asset to you if you're trying to do a trade like this. And you just want a little bit of movement away from the price, and that's where you get some nice gains. So 52% return on this trade in only 103 minutes. I mean, I'll take that any time. So you can see the net credit after commissions received on the trade was $96. I closed it out for net $44 after commissions. The risk was $100 on the trade. So we only had 2 contracts, and for a 5K account, that equates to 2%, which is what you should keep your risk to, 2% or lower than that for a small account. So are we going to retire on this? No, but I mean, this is something that we can chip away, and these are nice, effective trades, because what happens is if it doesn't work out, if the price keeps going lower, or if I get faked out by a signal and the price just kept on lower and this thing expired on the spread, I know that my maximum risk on this trade is going to be about $100. And losing one of these trades every once in a while for $100 is not going to take me out of the game. It is going to take you out of the game if you set these things up as a high probability trade where you get that small little credit and you set it up out of the money, and then once in a while you get run over and it's going to put you back to square zero. So these are the types of trades that I like with small accounts, where we get right in there at the money, hand-to-hand combat, and it's a little bit of a different experience for most people, since most option traders kind of learn by selling these options way out of the money, and they have this sort of illusion of safety. But that illusion of safety goes away if you get run over. And so as you progress in your knowledge and your skills of trading options, getting closer and closer to the money, I think what you'll find is that you'll see the benefit to doing so. And also what you notice is that when you sell right at the money, this is where your fastest time decay also occurs. And of course, being that these options are only just a few hours left to trade, they're bleeding time value like a madman. So I've got all the odds in my favor. All I needed to do was to catch the bottom for just 103 minutes in this case. That is today's Market Minute. Have yourselves a great weekend, and we'll see you at the next expiration cycle next week. Take care.